Welcome to Breaking News to Trading Moves.
Glad to be here. Looking forward to getting into this.
Yeah, we have a really compelling one for you today. Today, you will hear the exact headline numbers from the recent SpaceX initial public offering, followed immediately by a breakdown of the specific market winners and losers.
Right, because there's a lot to cover with this one.
There really is.
Yeah.
I mean, to set the stage for you, SpaceX has surged past a $2 trillion valuation after completing a stock market debut that is just, well, it's unlike anything Wall Street has seen before.
Completely unprecedented.
Yeah. And to visualize the demand here, I want you to think about a highly anticipated opening night for a blockbuster movie.
Oh, I like that analogy.
Right. You have the velvet ropes, you have the sold-out theaters, the anticipation building for months and months. But in this scenario, everyone, and I mean from massive financial institutions managing billion-dollar pension funds, all the way to individual retail traders operating right from their smartphones, they all lined up for a ticket.
Yeah, everyone wanted a seat in that theater.
Exactly. And over 510 million shares changed hands just to get that seat.
That 510 million share figure is, it's really the immediate standout for me. We are watching capital flow on a historic scale here.
It's massive.
It really is. It demonstrates a level of demand that crosses all boundaries of the financial markets. I mean, institutions want it in, retail investors want it in, and they were all competing for allocation at the exact same time.
Which is pretty rare, right?
Very rare. Usually, you see segments of the market sitting on the sidelines to observe how an initial public offering performs during its first hours of trading before they commit any capital.
Like a wait-and-see approach.
Right, exactly.
Yeah.
But here, the hesitation was entirely non-existent. The volume reflects an absolute urgency to own a piece of the infrastructure driving the future of the commercial space economy.
Well, before we name the specific winners and losers in the market, we need to establish the hard numbers of the IPO.
Yeah, the numbers give the full context.
Exactly. Because the financial reality dictates exactly why specific companies reacted the way they did today. The numbers alone are staggering, but we need to break down the mechanics behind them to really understand the market's behavior.
And the precise figures paint a very specific picture of market enthusiasm. So the company priced a record $75 billion offering at $135 per share.
Which is just a massive raise.
Yes, and when trading began, it opened at $150 and closed its first Nasdaq session at $160.95.
Wow.
Yeah, so that represents a roughly 19% gain on its first day.
Okay, so a 19% bump right out of the gate.
Right. And calculating the total shares gives the company a market value of about $2.1 trillion.
2.1 trillion. That's hard to even wrap your head around.
It is. To put that in perspective for you, a $75 billion capital raise exceeds the total market capitalization of hundreds of established companies currently listed on the S&P 500.
Just the raise itself.
Just the raise. And that 19% gain is also a crucial number.
Why is that specifically crucial?
Well, it shows strong demand, obviously, but it also means the underwriters priced it really well. If the stock had jumped, say, 100% on the first day, the company would have left billions of dollars on the table.
Oh, right, because they sold it too cheap in the offering?
Exactly. So a 19% pop is kind of that sweet spot.
Okay, but here is where I have to point out a glaring financial contradiction.
I think I know where you're going with this.
I mean, the company is entirely unprofitable. We are talking about a business generating $18.7 billion in revenue, yet it is trading at roughly 112 times that revenue.
Yeah, it's a wild multiple.
It is. How does a stock trade at a 112 times multiple if it isn't turning a single dollar of profit? I mean, the average company in the broader market trades at maybe 2 or 3 times its sales.
Right. Well, traditional value investing metrics are just being completely set aside by the market here.
So they aren't looking at current earnings at all?
Not at all. Investors are not buying current earnings. They are paying strictly for future technologies.
Okay, so what exactly are they pricing in?
Specifically, the market is pricing in the future of reusable rockets, Starlink, direct-to-cell communications, massive government contracts, and even possible orbital computing down the line.
So it's all about what comes next.
Exactly. To understand the mechanism behind a 112 times revenue multiple, you really have to look at capital expenditure.
Like how much they are spending to build everything.
Right. The company is spending billions upon billions of dollars building physical infrastructure, rockets, launch pads, and thousands of satellites.
So they are basically betting on the transition from building the railroad to just collecting the ticket fares for the trains running on it later on.
That is a perfect way to look at it.
Let's look closely at reusable rockets as the primary example of this.
Yeah.
Because the underlying logic is cost reduction, right?
Absolutely.
I mean, if a company can land a booster and fly it again within a matter of weeks, their operating margins eventually look entirely different from a competitor who just throws their rocket into the ocean after one single use.
Exactly. The rocket reuse changes the basic unit economics of SpaceX at its core.
It has to.
Yeah. When investors see that 18.7 billion in current revenue, they aren't looking at the loss. They project what the margins will look like when those future technologies mature and the heavy building phase actually slows down.
So they are buying the future monopoly.
Right. The capital being deployed now secures an infrastructure advantage later. The market is paying a premium today for a monopoly-like grip on launch services tomorrow.
Okay, so logically, the entities closest to the transaction and the technologies funded by it are the immediate beneficiaries. The clearest winners are obviously SpaceX itself and the Starlink commercial ecosystem.
Without a doubt, the IPO provides enormous financial resources for their most capital-intensive projects.
Because Starlink is not cheap to build.
Not at all. Expanding the Starlink constellation burns through cash at a staggering rate. I mean, they are launching hundreds of satellites to build a global internet network in low Earth orbit. Going public and securing a $2.1 trillion valuation gives them the currency they need to fund that expansion without constantly relying on ongoing private funding rounds.
So they have their own war chest now.
Exactly. And the companies directly tied to this ecosystem stand to benefit from that influx of capital, too.
Which companies specifically?
Well, for those watching the market, the specific tickers to track are SPCX for SpaceX and TMUS for T-Mobile US.
Wait, T-Mobile. How do they fit into the space race?
T-Mobile US ties directly into that direct-to-cell communications future we mentioned earlier. They are partnering to utilize the satellite network to essentially eliminate mobile dead zones.
Oh, wow. So your phone just connects directly to the satellite.
Exactly.
Okay, but all that capital flowing into the company didn't just move on its own. The plumbing of Wall Street had to actually handle a record-breaking volume.
Right. The infrastructure behind the trade itself.
Exactly. That brings us to the architects behind the scenes, the IPO banks and capital markets firms. Executing an offering of this size requires a massive logistical apparatus.
It really does. I mean, a $75 billion offering involves months of structuring, legal compliance, and road shows to pitch the stock to large institutional buyers.
So the banks are putting in a lot of work up front.
Yeah, and the banks involved benefit directly through underwriting fees. When an investment bank acts as an underwriter, they are organizing the sale, building the order book of interested buyers, and managing the actual allocation of shares.
Let's clarify underwriting fees for a moment, just so we're all on the same page. We're talking about the cut the banks take just for organizing the sale and assuming the risk of bringing the shares to market.
Right.
It's essentially a commission structure. Even a 1 or 2% fee on a $75 billion transaction translates to hundreds of millions of dollars in pure revenue for these financial institutions.
And that is just the immediate financial windfall.
There's more.
Oh, yeah. Beyond the immediate cash from those fees, managing a debut of this scale signals to other private companies that these specific banks possess the distribution networks to handle massive liquidity events.
So it's basically a giant advertisement for their services.
Exactly. It solidifies client relationships and builds a much stronger pipeline of future public offerings. When a tech company sees a smooth execution of a $75 billion deal, they know exactly which banks to call for their own public debut.
That makes total sense. So who are the big winners here?
You see this benefit flowing to the big underwriters. The specific tickers in the capital market space are MS for Morgan Stanley, GS for Goldman Sachs, BAC for Bank of America, JPM for JP Morgan Chase, and C for Citigroup.
Okay, but let me push back on the bank's exclusive grip here for a second. You mentioned earlier that retail traders got a piece of this.
They did, yeah.
Around 20% of the IPO allocation reportedly went to retail investors. Doesn't that mean the traditional Wall Street banks lost some of their usual control over the distribution process? I mean, usually, regular investors have to wait until the stock is trading on the open market, often buying in at a much higher premium.
You make a fair point. The traditional banks still collect massive fees due to the sheer size of the deal, but you're right, the distribution model did look very different here.
20% is a lot for retail, right?
It is highly unusual. Providing 20% directly to retail investors is practically unheard of at this scale. Historically, retail might see a low single-digit percentages of an allocation, keeping the most lucrative early pricing strictly reserved for preferred institutional clients.
So giving retail a big chunk changes the game.
It does. And this large retail portion drives elevated account engagement on consumer-facing brokerages, which brings us to another group of winners.
Right, this is a classic business dynamic. In a gold rush, the people who sell the shovels, in this case the exchanges and the retail trading platforms, are clear winners.
Exactly.
When 510 million shares change hands, the businesses processing those trades collect fees all along the way.
Yeah, the exchanges and platforms monetize this activity in multiple ways. Let's look at the exchange first.
Okay, Nasdaq.
Right. Nasdaq gains immense prestige and listing revenue from hosting one of the world's largest public companies. They also generate revenue from the data feeds that quote the stock's price to the rest of the market, and from the pure transaction volume crossing their servers.
And what about the retail platforms monetizing that 20% allocation? How do they actually convert user logins into revenue on opening day?
Well, when users log in, fund their accounts, and execute trades on a highly anticipated listing, platforms generate revenue through several mechanisms.
Like what?
For one, they earn money through payment for order flow, where market makers pay the brokerages to route the retail trades to them for execution.
Okay.
They also earn interest on the idle cash sitting in customer accounts waiting to be deployed. And they generate fees through margin lending when users borrow money from the brokerage to buy more shares.
Ah, so they make money from the hype itself.
Exactly. The volume of trading activity alone acts as a massive revenue driver. The specific tickers for the exchanges and platforms benefiting here are NDAQ for Nasdaq, HOOD for Robinhood, and IBKR for Interactive Brokers.
Okay, so we have established the winners.
Yeah.
But when one company absorbs this much capital, the entities competing against it face immediate pressure.
They absolutely do.
Let's look at the satellite communications competitors. The financial reality for these companies just became much harsher, and the market reaction was immediate. I mean, EchoStar fell around 11% on the day of the debut. Why such a severe drop on the exact same day?
It really comes down to how institutional investors allocate capital across the communications sector.
How so?
Well, these companies now face a publicly traded competitor with vast funding, a large installed satellite network, and incredibly strong brand recognition. Investors will now compare every single satellite communications company against Starlink's scale, their launch access, and their ability to fund expansion.
Well, it's like a new benchmark.
Exactly. Legacy satellite providers often rely on larger, much more expensive satellites positioned much higher in geostationary orbit, whereas Starlink operates thousands of smaller satellites in low Earth orbit, which provides lower latency connections.
And the launch access seems like the ultimate bottleneck here. The company isn't just competing with other satellite internet providers. It owns the transportation method. Those exact competitors need to get their hardware into orbit in the first place.
That is the crucial point.
It is like trying to compete with a delivery service that also happens to own every highway in the country.
That is a great way to put it. That physical control over the launch vehicles is a massive structural advantage.
I would imagine so.
Yeah, if you are analyzing a smaller satellite provider, you have to ask how they can compete on pricing when their competitor owns the literal rockets taking the satellites to space. They dictate the launch schedule and the launch costs.
So the competitors are at their mercy.
Basically. Companies like AST SpaceMobile and Globalstar might still succeed with their specific mobile connectivity models, but they face much tougher scrutiny on their valuations now.
What are the tickers for those facing this pressure?
The specific tickers are SATES for EchoStar, ASTES for AST SpaceMobile, and GSAT for Globalstar.
Okay, and that advantage in launch access leads us to the legacy defense and aerospace players, because the access to public capital strengthens the advantage in reusable launch systems, government missions, and national security contracts.
It puts a lot of pressure on the old guard.
Right. We are looking at Rocket Lab, noted as the closest listed pure play comparison in this specific sector. Then you have the legacy players, Boeing, Lockheed Martin and Northrop Grumman.
Yeah, let's break that down. Rocket Lab is the most direct comparison because their entire business model is built around launch services and manufacturing space systems.
But they do smaller rockets, right?
Yeah, they do. They operate smaller launch vehicles compared to the heavy lift rockets we are discussing, but they are still competing for the same pool of commercial and government launch contracts.
And the legacy players.
The legacy players have exposure to competing launch and space programs, but they are highly diversified conglomerates.
But if they are diversified, making commercial aircraft, ground defense systems, naval ships, why do they face pressure from a space-focused public offering? Their space divisions are just one piece of a much larger revenue pie.
That's true, but the scale achieved here increases pricing and innovation pressure on those specific space divisions within the larger conglomerates.
How does that work in practice?
It's because government procurement models are changing. Historically, legacy defense contractors operated on cost-plus contracts, where the government paid for all development costs plus a guaranteed profit percentage.
So they got paid no matter what they spent.
Exactly. It was very comfortable for them. But now, the government sees that one company can launch a payload for a fraction of the cost due to reusable technology and fixed-price contracts.
So the government is getting stingy.
Right. Agencies will now demand similar cost efficiencies from the diversified contractors, and that directly limits the profit margins those legacy companies can extract from their space divisions.
Okay, that makes sense. And the tickers to track in this category?
Those are RKLB for Rocket Lab, BA for Boeing, LMT for Lockheed Martin, and NOC for Northrop Grumman.
Which leaves the smaller space stocks competing for investor attention. We saw Planet Labs drop around 9%. As investors rotated their capital.
Yeah, that 9% drop perfectly illustrates the mechanics of sector capital rotation.
What do you mean by that?
Well, smaller space companies struggle when one dominant name becomes the default institutional holding. Imagine a portfolio manager who wants exposure to the space economy. Before this offering, they might have bought a basket of 5 or 6 smaller space stocks to build that exposure and manage their risk.
But now they don't have to.
Exactly. Now they can just buy the dominant player. That single entity absorbs the capital that previously flowed into the broader sector.
Let me challenge that logic regarding companies operating in entirely different niches, though. What happens to companies like Intuitive Machines and Black Sky? Planet Labs focuses on Earth observation, Intuitive Machines is working on lunar landers, and Black Sky provides geospatial intelligence. They aren't building a massive internet constellation or a reusable heavy-lift rocket. Why does capital rotate away from them if they aren't direct competitors?
It's a fair question, but even in different niches, they now face higher market expectations regarding their revenue growth, cash use, and overall profitability.
So the bar is just higher now.
Exactly. Investors have a new baseline for what a successful space company looks like. Institutional investors allocate a specific percentage of their total portfolio to the space sector. If the dominant player achieves rapid revenue growth and demonstrates a clear path to technological dominance, investors will just fill their entire sector allocation with that stock.
And the smaller guys get left out in the cold.
Right. They will demand that smaller companies in niche markets justify their cash burn. They will ask, if you operate in a specialized niche, why aren't your margins better? The scrutiny on every single dollar spent by Intuitive Machines or Black Sky increases simply because the standard for capital efficiency in the space sector just changed.
Got it. And the specific tickers here?
The tickers are PL for Planet Labs, LUNR for Intuitive Machines, and BKSY for Black Sky Technology.
So really, the cost of capital goes up when you have to prove your worth against a $2 trillion entity. It forces every boardroom in the sector to reevaluate their timeline to profitability. They can no longer sell investors purely on the promise of the space economy. They have to actually deliver execution that holds up against the industry leader.
Exactly. When a single entity absorbs so much capital and becomes the default institutional holding, it forces you to closely monitor how smaller specialized competitors will secure the necessary funding to survive.
Truly a fascinating market dynamic to watch unfold. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.